So guys, August was another very hot month on the stock market, and I'm not gonna lie, it's getting to be kind of slim pickings out there. But still, you know I always come through for you guys, and so in today's video, we'll be talking about 3 deeply discounted dividend stocks, all of which still look like great buys as we step into September. But real quick, before we get to those, I wanna hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. So in recent years, renewable energy has been getting a lot of attention. Solar power homes are becoming increasingly common, and electric vehicles are everywhere, especially here in Vegas, where it feels like you can't drive anywhere without seeing at least 4 Teslas. But anyway, this shift has led many to believe that renewables are set to take over the world and fossil fuels are on their way out. But I don't think it's that simple. People often underestimate just how deeply embedded into our daily lives fossil fuels are, and I think the transition to renewables is going to take a matter of decades instead of just a few years. And during this time, global energy demand isn't going anywhere but up, which creates a strong tailwind for companies in the energy sector right now, like Chevron, which obviously is our first stock of the day here. And if we look at Chevron's share price performance over here using Snapstock, we can see that it is prime for purchase. And in the last month, it's seen a pretty decent drop. It's down about 5.4%, which if we look over here is going to leave Chevron with a year-to-date performance of -1%. So it's still down here in 2024. And if we zoom out once more over the last 365 days, it's down about 4.25%. Not only that, but if we scroll down just a little bit looking at the 52-week range, we can see that Chevron is really not too far off there from its 52-week low. And as far as I can see, there are 2 things that happened in the last month to bring the stock share price into the red. The first of which was their quarterly earnings, which were kind of a mixed bag. While Chevron did report a 4.7% year-over-year revenue increase, which is obviously good, it ended up missing its earnings expectations, which definitely didn't do the share price any favors. And in addition to that, Chevron is facing some uncertainty surrounding its planned merger with Hess Corporation. Right now, there's a delay in their ongoing arbitration with Exxon over whether Chevron's bid for Hess triggered something called a right of first refusal clause in their Guyana joint operating agreement, and this has also negatively impacted the share price. And to expand on that a bit more, a large percentage of the production and free cash flow that Chevron expects to receive from this deal with Hess is coming from this joint venture with Exxon. The agreement between these partners includes what's called a change of control clause that allows the others to make a preemptive bid if one partner decides to sell their stake. Now, Exxon believes Chevron's acquisition of Hess triggers this clause, but Chevron obviously disagrees, arguing that it's buying the entire Hess company, not just its stake in this Guyana venture. Either way, the situation has had a negative impact on the stock share price. It's probably just in my opinion, some short-term issue that eventually will be worked out, but in the meantime, it's pushing that dividend yield up a little bit. Going back over to Snapstock and looking at the dividend stats here, right now the yield is sitting at 4.3%, which is really not too far off from the company's 5-year average. In the last decade or so, there were a couple times where Chevron's dividend yield got way up there. Like for example, it looks like the peak over the last decade was here in 2020, where the yield got up to close to 7%, and a few years before that in 2015, it was, not too far off from that either. But either way, the yield right now is looking pretty good, 4.3%. Definitely not going to complain about that. The payout ratios are looking good. Earnings payout ratio and free cash flow payout ratio are pretty comparable here, both in the low 60% range. And the growth stats are very, very consistent. They have a 5-year dividend growth CAGR of 6.15%, which I think is a pretty good CAGR considering this yield above 4%. So I like these stats here. I think they're pretty well balanced, and they're a dividend aristocrat with 36 years of growth. Now, switching gears and taking a quick look at my Chevron position over here on my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download the spreadsheet in the description of the video. But here we can see I have about 19.25 shares of Chevron at an average cost of $112.13, which is still quite a bit below the current share price. So even with the slight pullback we've seen in Chevron's price here, I'm still up quite a bit. I'm still up 31.6%. On a total return basis, I'm up even more. I'm up just over 44%. But with that said, even though it's still quite a bit above my cost basis, I don't think Chevron's a bad buy here at all. And actually, according to Snowball Analytics, it's about 3.7% below its 200-day moving average. And while I'm not much into technical analysis, I do know that the 200-day moving average or the 100-day or 50-day or, whichever moving average is a metric that more technical investors like to use to gauge a stock's valuation. So that's just another thing to consider. All right, guys, now the second stock on our list today is Insperity, which is a company that essentially offers full-service HR solutions for businesses. So instead of a business handling things like payroll, employee benefits, and compliance with labor laws on their own, they can outsource those things to Insperity. This allows the business owners to focus more on growing their companies while Insperity takes care of the HR side of things. And as a result, in their own words, they help businesses run better, grow faster, and make more money, all of which are good things. With that said though, guys, if you've been a shareholder of Insperity this year, you definitely would not have made more money. Taking a look at the share price performance, it's seen a pretty big drop in the last month. This company is down 7.6%, which is going to leave them with a pretty crazy drop so far year to date, down 17.64%. And if we zoom out once more over the last year, this also puts them in the red, down 5%. And at least here in the last month, we can see that the stock really fell off a cliff right here at the end of July going into August. The share price drop here came as a result of their quarterly earnings, where they reported slightly lower revenue than expected, even though revenue did grow by over 1% compared to last year, which overall is still positive in my opinion. But with that, the earnings results also showed a 1% drop in the number of employees Insperity manages for its customers, although their customer retention rate is still incredibly high at 99%. But this is worth noting because right now we're going through a period where businesses might be more hesitant to hire employees and expand, and they might even be, lowering the number of employees they have on payroll, which is going to negatively impact Insperity because their revenue is determined by the number of employees that they manage for their customers. Still though, in my opinion, guys, none of this is all too alarming. And in fact, if we zoom out across a longer period of time and look at the fundamentals of Insperity, we'll see that it's historically been a very strong company, and it still is. Looking at some of the growth metrics here, we can see that from top to bottom, Insperity has been a really solid grower over the years. I mean, the revenue's straight up and to the right, growing by an average rate of 11% over the last 5 years. Earnings per share has gone straight up and to the right. I mean, it dipped here in 2020 and 2021, but if we look at the general trend, it's been really solid, and the 5-year growth rate on the earnings per share is about 7%, not too shabby, and the free cash flow's really grown like a weed, guys. Over the last 5 years, the CAGR here is 14.2%, so that's great. And along with that, taking a quick look at the debt situation here, it doesn't appear that Insperity is at any risk of going bankrupt here anytime soon. I mean, their net debt is negative. That's a really positive sign. And now looking at the dividend stats, things are looking really good here in the dividend department. Right now, the yield is at about 2.5%. It's just right there in line with the 5-year average yield. But here we can see that Insperity has been a dividend growth monster over the years. This chart is exactly what you want to see. And this 5-year growth rate here says 33%, but it's a bit skewed. I mean, we can see that there's a few years here over the last decade where we see a really big spike in the dividend payments, 2021, 2017, and 2014, but these are all from paying special dividends in these years. So it looks like every few years, Insperity will pay out these large special dividends. But without those special dividends, the dividend growth rate is still very impressive. The real CAGR is close to 18%, maybe just above 18%. And they've also been growing the dividend for 13 years. So the streak is pretty intact. And I would imagine that Insperity will continue to be a pretty solid dividend growth stock moving forward. All right, guys, now the third stock we're talking about today is one that we've covered a couple different times so far this year. And every time we talk about this company, it just keeps going lower and lower. This company is AGCO, which behind John Deere is one of the country's leading manufacturers of agricultural equipment. So they make things like tractors, watering systems, feed storages, and stuff like that. And AGCO's had another really tough month, guys. I mean, first, they reported a miss on both the top and bottom line in their quarterly earnings for the third time in a row, actually. And they saw a near 15% year-over-year decline in revenue, which definitely knocked the share price down a bit, which we'll take a look at in just a moment. But to add insult to injury, now one of their biggest shareholders is pushing to see a change in the company's board of directors. Diving a bit deeper into this, Tractors and Farm Equipment Limited, which is based in India and owns 16% of AGCO, wants to replace the company's board of directors, claiming that AGCO has wasted billions of dollars on bad deals, it's engaged in poor governance practices, and has been outperformed by rivals such as Deere & Co., which is true. If we compare their total returns over the last 5 years, Deere has nearly tripled the returns of AGCO. And diving a bit deeper into AGCO's share price performance, this company has seen the largest drop of the day. In the last 30 days, it's down 11.2%, which if we zoom out looking at the year-to-date performance is going to leave them down 21.3% so far here in 2024. And if we zoom out once more over the last year, it's down about the same. They're down about 21% in the last 365 days. And with this drop in share price, guys, I can't help but notice how nice some of these valuation metrics look. I mean, starting with the PE ratio, 16.15, not too shabby, and this is about 33% below the company's 5-year average PE ratio. So that's looking really good. Price to free cash flow is nice and low in the single digits at 7.9, and this is about 54% below the company's 5-year average. The earnings yield is looking okay, 6.2. This is a bit below the 5-year average still, but the free cash flow yield is looking great, 12.65, and this is 100% above the company's 5-year average free cash flow yield. So that looks promising. And scrolling down, guys, looking at the growth metrics, not unlike Insperity, AGCO's been a pretty solid grower over the years. This chart's looking really good. This chart's looking really good. It has the 5-year growth rate at almost 150% for the earnings per share, but it's a bit skewed from these years in here. So maybe we'll just kind of disregard that number for now. But the free cash flow per share has really grown nice. This is exactly what you want to see, guys. And the 5-year CAGR on the free cash flow is about 14%. It's growing at a faster rate than the revenue. And scrolling down, looking at the dividend stats, right now the yield is about 1.25%, which based on this chart is quite a bit below where it's been these last few years. But if we look at the dividend per share chart, this has been skewed by special dividends that have been paid out in 2021, 2022, and 2023. We'll see if they pay one out in 2024, but they definitely were generous with their special dividends these last few years. And because of those special dividends, it has the 5-year dividend growth CAGR at like 168%, which is just out of this world. But without those special dividends, guys, the real CAGR is about 13.4%, and AGCO has a 10-year dividend growth streak. Overall, guys, I think AGCO is a really solid one to consider, even though it just keeps coming down in price. I still think right now is a pretty great price, and I think the same is true for all 3 of these companies that we looked at today. I think they're really great ones to consider. With that, though, these 3 aren't by any means the only ones. There are still a handful of other honorable mentions out there that I think you need to keep your eye on. The first of which is going to be Archer Daniels Midland, guys, who's seen a near 5.5% decline in the last 30 days. And if we zoom out looking at the year-to-date performance, the stock is down 15%. So I definitely think you need to keep your eye on this one. Next up, Dolby Laboratories is another one to watch. I think this is a really solid company, and they've seen a really big drop in the last month. They're down 8.2%, and year-to-date DLB is down 14.4%. So a nice pullback here too. Next up, guys, we have FactSet Research Systems, ticker symbol FDS, who's not seen a crazy drop in the last month. They're only down about 1%, but if we zoom out looking at the year-to-date performance, the stock is down almost 10%. So definitely keep your eye on this one. Moving on, guys, Humana is definitely another one to watch. The stock is down another 11% in the last 30 days. They really jumped off a cliff right here. And if we zoom out looking at the year-to-date performance, this is going to leave Humana with a 23.65% decline. Moving on, guys, I still think LVMH is a really solid company, and it's one to keep your eye on, even though it's seen a really nice climb in the last month. It's up 8% just in the last 30 days. But if we zoom out looking at the year-to-date performance, it's not too far off from break even. It's only up 1%. And if we zoom out once more over the last year, it's actually still down in this time period. It's down 9.5%. But anyway, guys, moving on to the next stock. This one is Lamb Weston, ticker symbol LW, who has rebounded quite nicely in the last month. The stock is up 12%. A really big climb for Lamb Weston, but if we zoom out, this stock is still taking quite the beating in 2024. It's down almost 40%. So yeah, definitely keep your eye on this one, guys. Even though it's up a bit in the last month, there is still room for this one to rise. And now, guys, moving on to this next one, I still think Nike is one to keep your eye on, even though it's seen a really nice climb in the last month. This is the best gain we've seen all day, up 17% in the last 30 days. So shout out to all you guys who recently started positions in Nike. That was a good move. I know Russ recently started a position in it, so all you guys are probably sitting real pretty with Nike right now. But still, if we zoom out, looking at the year-to-date performance, it's not been all sunshine and rainbows for Nike, guys. It's still down quite a bit here in 2024. It's down 19%. So like with Lamb Weston, this one still has room to run. Now moving on to this next one, guys, keep your eye on UPS. The price is looking pretty decent. It's really pretty much right there at their 52-week low, right? But in the last month, UPS is down 0.75%, nothing too crazy there. But if we zoom out looking at the year-to-date performance, it's down almost 16%. But here's the thing that kind of concerns me with UPS. If we scroll down a little bit looking at some of the dividend stats, it's the payout ratios. The earnings payout ratio and the free cash flow payout ratio are both over 100% in the trailing 12 months. And if we scroll down looking at the charts for these two metrics here, it looks like this has been kind of a recent thing, but I'm not really liking this trend that I'm seeing here in the earnings payout ratio. Since 2021, it's done nothing but go up. So I do think this is a bit of a red flag, and we're seeing a similar trend here in the free cash flow payout ratio. And in fact, in 2023 and in the trailing 12 months, it's up over 100%. So if you're going to be buying UPS, I think this is something to watch. This has me a little bit concerned, I'm not going to lie. But anyway, those are all of the stocks that I think are good ones to watch right now. And in this next video right over here, I'm telling you about 3 more stocks that are the exact opposite. These These stocks right over here are trouble, and you would definitely regret buying them. So click right over here to find out what they are, and I'll see you in the next one.